All right, let's talk about something that affects your money every single day, whether you realize it or not. We're going to pull back the curtain on exchange rates, that kind of hidden force that can make your dream vacation a total bargain or, a complete budget buster. Let's get right into it. So, have you ever noticed this? You're eyeing a trip, maybe to Europe, and one month the flight looks like a steal. The next month, the price is shot way up. Or how about that new smartphone that's made overseas? Its price tag just seems to jump around all the time. What is going on there? Well, the short answer, the simple answer, is the exchange rate. It's this number that's always moving, always shifting, and it connects your money to the entire world. It has a huge impact on the price of pretty much anything that crosses a border. So what exactly is it? Okay, let's start with the absolute basics. What even is an exchange rate? And more importantly, how does it actually impact your wallet? At its heart, an exchange rate is really just a price. It's how much of one currency you need to buy another one. So, for example, how many US dollars does it take to get your hands on €1? The thing is, these rates are not set in stone. Not at all. They're fluctuating constantly based on a bunch of key factors, which we're about to unpack. So, what happens when your currency gets stronger or weaker? Well, let's take a strong US dollar. That means your money goes a lot farther when you travel abroad. Awesome, right? It also makes imported goods, like a new TV, cheaper for you to buy. But here's the flip side. It makes American products more expensive for everyone else in the world. Now, a weak dollar, it's the total opposite. Travel and imports get pricier for Americans, but it's a huge help for US companies trying to sell their stuff overseas. Okay, so what is it that actually makes these rates move all the time? Well, two of the biggest movers and shakers are inflation and interest rates. You can think of them as these giant forces constantly pushing and pulling on what your money is worth. You can really picture this one like a seesaw. If a country keeps its inflation low, it's basically protecting the value of its money. It's preserving its purchasing power. That makes its currency way more attractive, and its value tends to go up. On the flip side, high inflation, that's like a slow leak in a tire. It just erodes the value of a currency, causing it to lose ground against others. And then there's interest rates. This is fascinating. When a country's central bank, like the Federal Reserve here in the US, raises interest rates, it's like turning on a giant magnet for foreign money. Investors all over the world see those higher returns, and they want in. So they start moving their capital into that country. And to do that, they first have to buy that country's currency. All that new demand, well, it drives up the exchange rate. Simple as that. Okay, so beyond just inflation and interest rates, the overall financial health of a country plays a massive role. You can think of things like deficits and public debt as a country's financial report card, or its credit score. And you can bet that international investors are looking at that score very, very closely. So what's a current account deficit? It sounds super complicated, but it's not. It just means a country is buying more from the world than it's selling to the world. It's spending more on foreign stuff than it's earning from its exports. To do that, it has to supply more of its own currency to the market, and that can push its value down. And a big pile of national debt? Oh, that definitely sets off some alarm bells for investors. They start to worry that the government might just print more money to pay off the debt, which, as we know, leads to inflation. Or even worse, they get scared that the country might actually default, just fail to pay its debts. These kinds of risks make the currency look a lot less attractive, and that can really hurt its value. A country's credit rating is a huge deal. All right, one last major piece of the economic puzzle we're going to look at is something called the terms of trade. It sounds technical, but it's really just about the value of what a country sells versus what it buys. Basically, the terms of trade is just a ratio. It compares the prices a country is getting for all the stuff it exports to the prices it's paying for all the stuff it imports. It's a really powerful snapshot of how much demand there is for a country's goods on the world stage. So think of it this way. If a country's terms of trade are improving, it means the world is hungry for what it's selling. People are willing to pay more for its exports. That demand for its goods translates directly into demand for its currency, and that boosts the exchange rate. But if the terms are getting worse, it signals the opposite might be happening, and the currency's value could fall. Okay, I know that was a lot of economic speak, but let's bring it all home. How does all this global push and pull circle back and affect you and your money? Let's connect the dots. This really is the million-dollar question, isn't it? Or maybe the million-euro question. So what's better, for your country's currency to be strong or for it to be weak? Well, as with most things in economics, the answer is It's complicated. It really truly depends on who you are. If you're an American tourist planning a trip to London, a strong dollar is fantastic. Your money buys more. If you're a company that imports electronics, you're loving it too. But if you're an American farmer trying to sell corn overseas, a strong dollar makes your product more expensive and harder to sell. There are always winners and losers. And hey, if you have a 401k or any kind of investment, listen up, because this part is huge. Exchange rates are the silent but really powerful force working on your portfolio. A fallen currency can actually eat away at your investment returns because it lowers the purchasing power of your money. It also has a big ripple effect on the profits of any global companies you're invested in. It's a bigger deal than most people think. So you see, the global economy is like this giant interconnected puzzle, and exchange rates are just one crucial piece. They're tied to everything from interest rates to public debt to the price of your groceries. Now that you know how they work, you've got a new lens to see the world. So what piece of the puzzle are you going to watch next?